How can you reduce your risk when you're investing? That's going to be the topic of today's video. Okay everyone, if you're an expat or a high net worth individual in particular, go over to adamfire.com and see how I can help you. Now on this video, I'm going to talk about reducing risk, some of the obvious ways to reduce risk and some of the less obvious ways to reduce risk. So let's start with some of the obvious ways to reduce risk. First of all, diversification. Don't put all your eggs in one basket. Asset diversification. So if you put all your eggs in, for example, one stock, say Amazon stock, that's going to be much more risky than, for example, investing in the S&P 500, which is 500 of the top stocks, and you're not stock picking. But likewise, if you invest in the global stock market in addition to the global bond market and other asset classes, it will reduce your risk, even if it reduces your return in certain situations. However, another thing is time diversification. What do I mean by that? Now, stock prices historically have beaten T-bills, which are a type of short-term government bond, and indeed government bonds, corporate bonds, and pretty much all assets long-term, but it's more volatile. However, one of the ways to deal with this is to invest long-term. Many people have been down by investing in the stock market for 1 year or 2 years. Over a 5-year period, there's about a 14% historical rate of failure. In other words, failure for people who just invest for 5 years, then sell out. That reduces to 10% after 10 years, but after 25 years, it goes to 0% across most of the major stock markets. However, this leads me to number 3, which is reinvest dividends. This is quite important because it's a bit like if you buy a house, the whole point about buying a house as a rental property is to get capital appreciation, but also a rental yield. But when it comes to the stock market, very few people talk about the importance of dividends. On the news, they'll say things like the S&P 500 has hit a record high today. They don't say the S&P 500 has hit a record high and, oh, by the way, if you would have invested dividends, it would be worth X and Y amount. But actually, say since World War II, many stock markets, more than half of the return has been through reinvesting dividends. And I'll give you an example about how this really reduces risk. The FTSE 100 in the UK has been stagnant pretty much, not completely, but pretty much since 2000. It's performed very poorly compared to the FTSE 250 and indeed the S&P 500. However, even if somebody would have had 100% of their wealth in the FTSE 100, which wouldn't make sense compared to being more diversified, they would have actually made money above inflation if they would have just reinvested the dividend every single year, because the FTSE's kind of consistently given 3, 4, 5% returns in that time period. An even better example would be the Japanese stock market. People say, oh, the Japanese stock market is the only stock market which hasn't hit all-time highs. But even in the very unrealistic scenario where somebody bought right at the peak of the Nikkei being 38,000 and sold this year when it hit 30,000, they would have actually made some profits if they would have reinvested dividends. So reinvesting dividends is quite important. If you buy and hold, you're probably long-term going to get good capital value appreciation. But if you buy and hold and reinvest dividends, even if you happen to invest in a bad market, you're going to be up. And finally, you could try some things which are a bit more risky. For example, using leverage when you're young. Now, I said it's more risky, but there are alternative interpretations of this. I spoke about this on some videos before, where there's some new research, or relatively new research, which shows if a young investor specifically uses leverage to buy more stocks, it's actually not as risky as people think. Actually, in a counterintuitive way, it can reduce risk. I'm not convinced by that argument, but just as something kind of to throw out there as something which is completely different, a little bit eccentric, there is some academic research which challenges the idea that leverage is always risky. Yet leverage is always risky if you go too much, too soon, or for that matter, if you're always leveraged. But some authors have actually suggested if people just specifically in their 20s and 30s actually use debt and leveraged ETFs to buy more stocks, but then take some of that risk off the table when they're in their 40s and 50s, that can actually lower the risk, ironically. How can I help you? In two ways. First of all, are you an expat, a high net wealth individual, or just somebody who lives in a part of the world where it's difficult to get access to quality investment solutions? In which case, go onto my website on adamfayed.com and find out more. If you don't fit into any of those categories, then in which case there's a range of free material on my website, on this YouTube channel, and indeed on my Quora, where I get over 200 or have received over 231 million views in the last few years. And finally, if you want to actually read my thoughts in more detail, go onto Amazon and find my book on there.